Hey, welcome back to the Market Mindset Podcast. I'm Matt Laridan, your host. Thanks for joining us. Today we have Zach Soder. He is the senior managing partner over at Soder Capital, located in Charlotte, North Carolina. It's a private equity firm focusing and specializing on syndicating multifamily deals. Past performance, not indication of any future performance, and do your own due diligence. I'm still digesting, going through, reflecting on the time Zach and I spent together. He and his team take due diligence to a whole new level. I mean, whole new level, but yet way down to the granular level. And you'll see what I mean when you watch this, the interaction that he and I have together. Handing over hard-earned resources, hard-earned capital, both pre-tax and after-tax, is a big step for investors. And I'm telling you, again, I'm not invested with him. I don't have a financial interest, but I'll just let the podcast take care of itself. It was a great pleasure, great honor to have Zach Soder, senior managing partner over at Soder Capital out of Charlotte, North Carolina. Welcome back to the Market Mindset Podcast. I'm Matt Laridan. Just thrilled to be back doing another podcast here today. I get to speak to Zach Soder with Soder Capital. He's the manager partner there, and this is just right up my alley. I love talking syndication. I love talking multifamily, and I really love storage as an investment strategy. Zach, thanks for taking the time out of your schedule today. We talked a little bit about kids. I've got 3 grandkids. You've got a little baby running around. How's that going for you?
It's been a very fun month. She actually turned 1 month today, so it's
Oh,
been
wow.
it's been an adjustment for us, but it's the greatest blessing that we've ever had. My wife and I are incredibly blessed to bring her into the world. Her name's Kennedy, and it's been a very fun month. Wife gets to stay home with her now. She has a long maternity leave, and trying to adjust to a newborn and a capital raise and the whole nine. It's been
Well,
very fun.
yeah, throw it all in right at the end of the year. I
Yeah,
love it.
exactly.
Yeah. So we talked a little bit before we started recording. We talked storage, we talked multifamily. Are those your buy boxes behind you?
So I have my crazy board and brokers and capital raisers and potential investors, a DD checklist on here, and then on the other side is filled up with a bunch of properties that I'm looking at. So I like to have things written down. I have my CRM as well, but I like it written
Yeah.
down.
Oh, I'm right there with you. I've got one over in my other office. And what I found is for me, I don't know how yours works. I can turn it upside or long ways and divide it up half and half. But yeah, I have one of those in my office. I should have it back here as well. How talk to me about number one, multifamily, two, what you like about storage, how you syndicate. I'm throwing a bunch at you, but I'll remind you how you syndicate your deals. And then we talked about cost segregation, which I don't think gets discussed a lot. But let's talk about your fund, who's it targeted, what you're purchasing, and then how it benefits investors.
Yeah, absolutely. So I started this journey about a year ago, a little over a year ago, and actually spent time on Wall Street. I was recruiting for some hedge funds and private equity groups and ended up leaving that and thought I was going to go start rolling up small businesses. And then kind of came across the cost seg and was like, okay, it's great. You can go buy a business, but you're still faced with a 30-40% tax bill at the end of the year. And this real estate, including the cost seg, was a good way to kind of get some taxable benefits along with the cash flow that you're really buying. So we'll really look at, multifamily is really our core right now. I just brought on a partner to do some more stuff with the self-storage. But multifamily, that's 80 plus units across the Sun Belt is really our buy box. I would prefer to get into multifamily that we can have a leasing person and a maintenance person on site. I think that allows your properties to be managed a little bit better. I don't necessarily have to be on site all the time. I can focus on more big picture asset management and, of course, more acquisitions to add to it. So I would really prefer to get into assets that we can pay our investors, an 8 to 10% pref, and hold for 3 to 5 years. So our target investor avatar is people who want some more cash flow. Traditional syndicates, you'll usually be, 5, maybe 6, even 7% you'll see, but I would like to bump that up a little bit higher and really targeting people, like myself who want to go spend more time with their family and their kids and things like that, and really free up some cash flow through the real estate is really a big part of our portfolio. only look at, landlord friendly states right now, North Carolina, South Carolina, Georgia. And then, we'll start to expand into Oklahoma, Arkansas, Alabama, maybe Mississippi as well. But I want to get into places that I can potentially evict people. I don't ever want to go and have to evict people,
Right.
but when you're going up and raising rents, obviously, you're going and renovating units, raising rents. It happens every so often. So we have a deal down in Tift County, Georgia right now that we're raising for. And if I go to court on Monday, the judge will hear it on Tuesday. Sheriff's tacking it by Thursday, and we're getting them kicked out within the week. So
Yeah.
those are like the best counties to be in my opinion. So try to stay away from some coastal markets as well,
Yep.
because insurance has just gone bonkers down there. Long term, I want to set up a master policy on the insurance and get into some more of those coastal markets, but I would rather be in, infill lots in the center of these states right now. Makes more sense for insurance. So that's really kind of what we target is those 80 plus, multifamily units, and then going to start going some more into self-storage down the road as well. I would love to be in self-storage. It's just hard to find stuff that pencils right now. Everyone tries to sell me stuff that's cash flowing 1.5%. It's just not going to work.
Yeah, no, I know, and I had a great guy on last week, and we were, or about 10 days ago, and he said this basically the same thing. He's not buying anything out here in California, Oregon, Washington, where it's just not investor friendly. I mean, it really isn't. Great, you've got location, you've got populations that are pretty powerful, but the regular, I know people who, if they weren't well bankrolled and well financed, they would have been out of business with all, these rent caps and the inability to collect rents in a timely manner. And it just wasn't investor friendly. Circling back to the multifamily, yeah, I mean, I love that you're targeting 8, 9, 10 cap rates. Where, I mean, without giving us too much information, letting out the secret sauce, because that's why we invest with you. That's why we pay you. Broadly defined, what are some areas where you might be seeing, let's just say your buy box is 60 plus units, right?
80 plus, 80 plus I would prefer, but we could swing a 60 depending
Okay,
on the
so
cash
just
flow.
say, so let's just for our audience sake, where are you buying 50? Where would you send people with 50 units or less to find a good cap rate like you're talking about?
Yeah, really, you really have to look in some secondary and tertiary markets is where you have to go. You're not going to find anything. I'm in Charlotte. You're not going to find anything in Mecklenburg County that's cash flowing like that now. Even like Catawba County out that way is tough. So, really looking across South Georgia is a big market and a big target for us. And then moving across North Carolina, in between Charlotte and Winston-Salem, and then in between Winston-Salem and Raleigh, like towards Burlington and stuff like that. So really some more of these secondary markets that you're starting to see people flood out of. I mentioned that deal down in Tift County. Most people haven't heard of Tift County, Georgia before, but
Right.
I'm able to go buy, a nine cap down there and pay, a 10% pref on a deal. So you really have to be comfortable with getting into some of those markets. South Georgia in general, I'm very bullish on. The administration down there has done a really good job of expanding some, manufacturing and things like that. I'm looking at a property out in Waycross, Georgia right now because they're building a, $750 million facility for a building manufacturer that's down in that area. It's going to bring 1,500 jobs. So while you wouldn't really think of South Georgia being a great market in the past, if jobs are coming down there, which they are, because people need to get out of the big cities now, you're going to see a lot more of those higher cap rates. Especially down in like Columbus, Georgia, is a good market for us moving forward. Especially Columbus, you're right on the line of Alabama and Georgia, so people will live in Columbus and work in Alabama, or vice versa. So you can kind of be down in some of those markets. So really it's maybe not going to fit the all LP investor profiles to be in secondary and tertiary markets, but that's kind of where you have to go if you want cash flow. And I'm fine with getting into there and then potentially refinancing or selling, quickly if we need to. But you have to be comfortable with holding properties for the long run as well, is kind of part of our game plan as well. We have a 3 to 5 year hold on our properties as the quote unquote life of the fund, but that could be cashed out through a refinance as well and maybe create some infinite returns for investors after that as well. So my goal is still, no matter where we go, to return investor capital within that 3 to 5 year window, preferably closer to that three than the five. But that may still still involve us holding the property for the long run, but we'd completely de-risk you, return all of your capital, and go from there. So, really to answer that question though, is some of these secondary and tertiary markets you have
Yeah.
to be comfortable with and get access to CoStar reports. And that's really why I focus. I grew up in Georgia and I live in North Carolina now. So those are two of our bigger markets because I understand what some of those secondary markets look like. You have to really be careful. I underwrote a deal in Montgomery, Alabama a few weeks ago, and then come to find out, like, look, Montgomery is a secondary market now, and it's probably going to become a tertiary because people are fleeing from it. So you really do have to be careful in the vetting, but that's where we'll look.
Yeah, well, I love your sort. I mean, you do a macro and a micro approach to in your analysis. I mean, but I love the fact that you're looking at where I always love looking at where businesses are going, and the fact that they're putting these big industrial facilities in, going to create job growth, which I mean, people are going to flock to as far as tenant occupancy is concerned. Um, how much leverage are you using in this first portfolio, this first fund that you're putting together?
Yeah, it's right at 61%, right in between there. So we're pretty low leveraged on it, which is good news. I'm actually assuming a HUD loan that's 3.84% interest. So it's a 35-year amortization on
Stop.
it. Yeah, it's
Stop.
incredible. It's
Stop.
incredible. You can't beat it on this market. I mean, even with the Fed cut the rate, which I don't think Powell should have cut it, but
Right.
he did, and you're still seeing mortgage rates go up, which is absolutely crazy to me. It's mind blowing. But yeah, 3.84% interest. We
Oh,
are paying some principal and interest on it as well. So
yeah.
that's good and bad. It makes the payments a little higher, but we're reducing the principal on it for when we go and refinance or sell. So low leverage, it'll allow us some opportunities to lever that up in the future if we need to, but I would prefer lower leverage. I think it's, a little bit less risk that
Yep.
does dilute some of the investor returns in the long run, but I'm really going after some risk adjusted returns. I don't think you need to hit 35, 40, 50% returns to be successful in this space. You really just don't.
Right. Right. And how much, I mean, if you're looking at a property, what type of improvements, enhancements are you looking at a prop? I mean, I mean, it sounds like, and we were discussing this a little bit before, but you might want a property that has some maybe not structural challenges, but other types of challenges. I mean, I, if someone, and I guess I'm circling back to here, if someone's to approach you with a deal, what are you looking for so that they're not wasting your time and they're making a good presentation to you?
Yeah, well, one, it just has to be, a rent premium on it. So whether that comes through like a true value add where we have to go and renovate every single unit because it was built in 85 and all the units are still from 1985, like
Uh-huh.
you can obviously go and renovate stuff and increase rents. Or this one in Tifton has some operational stuff. So it's a family or an owner operator that I'm buying it from, and he has about $130 a month in loss to lease. So he'll have people renting a unit for $900 a month and some people renting that same unit across the way for 600. It's like, okay, we need to raise that rent from 600 to 900 because that's what the market's bearing right now. So whether that's through operational, stuff or going and doing some true value add, this loss to lease play, what we're going to do is create some more tenant engagement stuff. So we're going to go renovate the pool room, get new pool furniture in there, do like some gas grills and things like that to really make more of a community with your tenants.
Okay.
I don't even really want to view them as tenants. You want to view them as residents and people who want to be there for the long run and view this as their home because one, they don't destroy your stuff if they were to move out. And then two, I just think it's the right thing to do. If we were to ever sell our home and move into a place, I would like to move into one of my apartments that I own. And that goes through, creating a tenant environment that is conducive to that. So I just need to have, I'd say at least I would like to be, 8 to 10% under market value, whether that's through renovations or just through some operational stuff that we can come in and capture the loss to lease and go from there.
Yeah. Oh, and I love, and you just put it in perspective, and what a great pitch. I mean, sales point, whatever we want to talk about it. I want to, if I want to move into a place, I'd want to be able to move into a place that I'm managing or owning. And that's a great attitude. Um, I mean, you're looking, let's call it let's just call it 70 plus units. How in depth do you go in analyzing the rent rolls on those?
Yeah, I mean, super in depth. I'm right now in a due diligence period, and I have we'll go as far as getting a third party due diligence company to come in, and he will look at the rent roll and compare that. I get all of the leases, all of the applications, and they will go lease by lease, line by line on the rent roll and make sure all of that matches up and all that good stuff. So we are very thorough in your due diligence. I think that's probably the most important part of doing a deal, even after you get it under contract, is going through that due diligence period, like getting periodic rent roll updates, getting all of the leases. Like I need to see every one of the leases, and I need my third party guy to be in every single one of the units. And like when he was going and touring the units when he was on site, he was talking to the tenant and like confirming that the name that they said when they let you in was matching the lease, that matches the rent roll, and we can see those deposits coming into the bank account. Like that's the most important part, because if I think I'm walking into a property that's, getting $1 million in revenue, and then I buy it and get in and find it's only 750 grand, like you just got smoked on a deal, and you can't recover from that. It's a huge loss. So like you have to be so thorough on the rent roll and the leases and all that good stuff.
Yeah. Are you looking for specific lease durations and built-in rent increases when you're doing that? I mean, do you shy away from tenants that have super long leases or rent? No?
No, we just have to kind of factor it into our underwriting.
Okay.
I view it as at least a 24-month play to turn over all of the leases, and we'll roll that into the underwriting as well. So, year two, you'll see, a decent amount of increase, but it's not until really year three that you're going to start seeing some of these things. So, most people don't have longer than a 12-month lease from what I've seen, but
Okay.
if it is longer, that's fine. It's not like we're expecting to capture that entire lost lease in a 12-month, because there's people who will sign leases, the month that we buy it, and
Yep.
won't be able to capture it on. So you can't expect, year one to be fully leased up. It's just not going to happen. So I view it as at least a 24-month play on the loss to lease. And then if you're on a true value add, you have to kick people out, renovate, and lease it up. That might be closer to a 36-month play on a true like value add.
Okay. I love your number. I love just how in-depth your due diligence is. I mean, really, that's very, very extensive. As an investor, that makes me feel really, really comfortable. Um, I'm gonna ask two more questions, and hopefully we have time to segue into to storage. As far as your fund is concerned, is it eligible for 1031 exchanges? Can someone 1031 exchange into your fund right now?
No, I have
Okay.
not set that up yet. I know that's a play, and I know Grant Cardone is doing some stuff with
Oh,
that.
he
When
is.
you're, yeah, he just set up something with it. There's some extra legal work that goes into it, from what I've been told. So it'll
Okay.
be a long run play of mine to do it. But as of now, everything I've been told, you can't. If someone really, really wanted to, we could press it and try to see if we could, but I just don't think you really can. It's
Right.
tough because what you're doing is it has to be like in kind, right? And then you're
Right.
like the 1031 guy, and it's
Yep.
just like if you're managing it yourself, the benefit of getting into a syndicate is you get the real estate benefit while being hands off. You don't have to do anything. You
Yeah.
put the check in and you take the check out, and that's just so much different than 1031ing something that you were doing on your own. So
Yeah.
that's everything I've been told, unless you know differently.
Well,
Like,
no,
have
I
you
just I'm
seen?
thinking I'm thinking of, these Delaware statutory trusts that, that are
Mhm.
1031 exchange eligible. And if you have a $50,000 capital gain in a piece of property that you want to, defer capital gains taxes, sure. Defer the capital gain into a Delaware statutory trust. But when you get in the 100, $200,000 capital gain challenge, go find another property or invest in an opportunity zone. I know we talked a little bit about opportunity zones earlier. Um, and the second part, is your fund eligible for self-directed IRAs yet?
Yeah, so yeah, we will
It
take
is.
self-directed IRA, solo one,
Awesome.
401k, all that. I'm a firm believer in using that. Like people, especially they leave jobs and they leave behind three 401ks, and they're like, I don't know what to do with it. And you can go and invest, that money into our fund. I think it's the best way to utilize your IRA. You can go get 8 to 10% on the stock market now, but I'm offering, 8 to 10% cash flow plus the back end promote on it. You're at a 20 to 25% IRR at the end of it. So like that's just a way better use of your money, especially in the IRA space. So
Oh, I do.
yes.
Oh, I agree with you. Then, maybe take that. I mean, does this generate cash flow for the limited partners every month? I mean, are they receiving
Yes.
distribution?
Yeah, so yeah, we're gonna start. We do monthly distributions starting the month after close. So February 1st close, we're gonna start distributions no later than March 15th.
Oh, wow, wow.
Yep.
That's awesome. And if they want exposure to the stock market, maybe just dollar cost average into a fund. I mean, who knows? And there's all kinds of opportunities. Who are you using as your trustee out there as far as retirement
Um,
accounts?
I have my equity trust
Okay.
that is linked directly to my portfolio. I know a self-directed IRA guy who can refer people out if they
Okay,
don't want to
great.
use my equity trust, but my equity trust is linked directly to your investor portal or my investor portal, so it's like the easiest way to go in my opinion.
That's great. I'm gonna give our viewers and listeners and people your contact information at the end. We don't have a lot of time left. Let's talk about storage. I love self storage. If you were to
Yes.
buy self storage, I know that the premiums are. I mean, it's a premium market. What do you like about self storage? I'll let you share.
I like that it pairs well with the multifamily, especially as we move more towards a renter society. People are just getting into apartments and they don't have as much storage space in those apartments, and it allows you to keep some of your stuff. I'm very big on it around here. We're by Lake Norman, and it's $750 a month to keep your boat on the water around Lake Norman. I want to go buy a self-storage facility and we can rent people 300, maybe $400 a month to store their boat in there and all of their lake stuff and all that stuff, especially if you live in an HOA that doesn't allow you to keep your boat at your house. You have to keep it in a storage unit or keep it on the water, and it's far too expensive to keep your boat on the water up here. So I'm really bullish on it, especially if people are in, apartments and all that stuff. I mean, in our house, we're like out of space. I'm thinking about going and getting a self-storage unit for
Yeah,
myself because I don't have enough space in my house. We just keep our house a little bit smaller and it doesn't make sense. So it's kind of on the flip side though of what I said with the multifamily and secondary and tertiary markets. You really want to try to be in primary markets with self-storage. Like once you get into like tertiary markets, there's no HOAs and you can keep your stuff wherever. So it's
yeah,
like the reverse market that we'll look at with the self-storage actually. But I'm very bullish on it. You don't have as much risk, in my opinion. You can get the properties for a little bit cheaper. You can go buy a 150 unit self-storage unit for 1.5 million instead of 150 unit for 10.5 million on the multifamily side.
yeah. Yeah, no, I love the cash flow. And I was reading some studies, and it's like on average, in a well-run, clean, organized self-storage facility, you can increase your rents 9% every 9 months. I mean, what an inflation hedge. You're going to lose some tenants, but the math, fact pencils out that the tenants you lose are going to be more than offset by the rent increases. And that's if you have a good, clean, well-run facility.
Yeah,
Um,
exactly. And you can pair it with some parking as well and get outside and like you don't have to insure that as much. Insurance can be a little bit lower and you don't have to
yeah,
worry about your stuff burning down and whatnot. So like if you pair it with some parking as well, I think it's a phenomenal opportunity if you have some space and some land.
yeah, yeah. Would you ever consider building storage, or do you want to be and let the populations reach you, or is that too long of a hold for your investment parameters?
In the long run, yes. But where we're at with monthly distribution starting the month after
Okay.
close, it's just not possible to do development. I view things in like a 3-year bucket and have a vivid vision that I wrote, if you're not familiar with that, where I wrote it out for 3 years. And the next 3 years, I would imagine that we're going to do some more development. But one, development costs are it's still far too expensive to do
Yeah,
stuff right now. But I would love to be in some new development, but in the short term, it's just not part of our portfolio. I need to get a better head on our shoulders about it. And something that I'm fine with rolling more of my capital into something that's a long run play is something, but it's just hard right now with investors to go and raise capital on something that, hey, give me some money and I'm not going to be able to pay you for 2 years. It's
oh
just
yeah,
like it's not a great market to be in right now, in my opinion.
yeah. Would you, if for self-storage, would you buy and manage, or would you buy and maybe lease out to a management company?
Um, I would buy in. So I have a partner who I just brought in who actually works for Public Storage, the big orange one, and
Okay,
I
yeah.
think So we'll probably just use them as the management company on it actually, and buy it and go through them. That being said, like. I'm open for looking at stuff, but really what I would prefer is stuff, like I said, that I can be more high level and just do some more like asset management rather than property management. So I always prefer to have like a property manager and someone on site and all that good stuff. I'm not a property management expert. There's people who are way better at that than
Right.
I am. So I would like to be able to throw it on the P&L and trust them to run it, and I can focus more on executing the business plan and going out and buying new stuff.
Oh, that's great. That's great. I mean, you have such an analytical Wall Street mind. I love it. I love talking about that. But you were oh yeah. So you were doing some recruiting and you said, "No, I want to go out and get down to the granular level, put funds together." I That's just phenomenal. Um, we talked about your buy box and resident or the multifamily. You're looking at storage possibly in the future. How do investors get a hold of you? And do you talk to other brokers? Do the brokers present you deals? Do you see that happening?
Yeah, I'm talking to brokers all day long. It's really what the name of the game is for me. So yeah, I have a good relationship with a handful of brokers. Marcus and Millichap, I love talking to, building relationships with other brokers as well that I know. But yeah, I that's kind of my job is to find and vet the deals. I probably underwrite, 8 to 10 deals a week. Not necessarily the full underwriting, but I'll look at, 8 to 10 solid deals a week and try to find the best ones for our investors to be able to go under contract with and present. So you can find me on all my social medias. Soder Capital is a good way to reach out. And then my email address is zach@sodercapital.com, but where we're at as the fund, me as the senior managing partner, you'll always have access to me. I have a handful of other partners in it. I have a multifamily partner who owns and operates 2,500 units across South Georgia. But at the end of the day, you'll always have a touch point with me. We're going to do monthly distributions, monthly reports, all that good stuff. I really want good long-term relationships with my investors. I don't want, investors who are just going to drop capital and then leave and, go from there. Like I want true long-lasting relationships. So you can find me on Instagram, Facebook, LinkedIn. I do have a Twitter, which I don't necessarily use a ton, or
Oh, I
X or
know.
whatever
Yeah.
you want to call it now. I need to
Yeah.
get better at that one, but LinkedIn, I'm all over all the time. Love using LinkedIn, and then Facebook, and Instagram. You can see, it's a blend of personal and business as
Good.
well. So you get to see my family and my daughter. I'm very open about that. I think that's the best part about this is I don't want people who are just dropping real estate knowledge all over the place. Like I think we need to have a relationship that's a personal level, and the real estate's a part of that, but it's a relationship that we have that goes beyond just seeing what you think my real estate, thoughts are.
Yeah. How close are you to closing out your first fund?
Yeah, we're going to close February 1st. So it's a HUD loan assumption at like 3.84%, like I said, but
Oh,
it's HUD takes forever, if you didn't know that. So
yeah.
we are going to close out February 1st. We should have the fund fully raised by the end of the year. So we should be done December 31st. But for people who are looking for some stuff in 2025, I know you kind of mentioned some cost seg as well. We're going to do a cost segregation study that will apply in 2025 and get a 30% loss on your investment in year one starting next year. So there's some great benefits for investors who want to start looking more towards 2025.
Yeah. No, I love that. And that, by talking about it today, investors can start, targeting or looking at those potential returns, where how they're going to reallocate their portfolios, certainly with some economic uncertainty coming up. Um, are you taking institutional money at all?
Yeah, I would love to take institutional money. Definitely open for it. We don't necessarily have the longest track record in the world, so some of the institutional money is a little bit harder to come by. But I'm going to start building a relationship with those folks. But yeah, if someone wants institutional money, I would definitely be open to having a conversation on it.
Yeah, well, I'm telling you, I would put you in front of any hedge fund that I know. I love your granular level research. I love your, just your overall perspective on real estate, and balance with family life. And then the fact that you said, hey, I want to be able to move into one of my apartments that I'm renting if that's what my wife and I and my beautiful new daughter choose to do. So I just appreciate you, Zach, taking the time out of your schedule today. I know you're busy. That little brand new baby, congratulations. You got a well behaved, looks like a little husky in the background.
Yeah, husky I got on Craigslist for $400 during the
Nice.
pandemic. You can't beat it. So yeah, we got two dogs at home. We're we're setting up our family foundation as well. So the Soder Family Foundation will go live next year, and we'll donate 10% of our profits to a lot of animal rescues, mental health stuff, things like that. It is part of our long run goal as well.
Wow, well-rounded. Man, I appreciate you carving out some time for us today. I'm going to put your contact information there. You said Zach at Soder Capital, is that correct?
Yep, Zach at sodercapital.com, and then Facebook, Instagram, LinkedIn. Feel free to reach out. I'd love to have a conversation.
You're awesome. I really do. I don't care if anyone watches this, but I learned so much from individuals like you. You keep me sharp. You're on top of it. You're young, aggressive, family oriented. Thank you for coming on. I know it's going to be a real benefit to a lot of people. And then for any, agents, brokers that have, 80 plus units, in the Sun Belt in second, tertiary, third markets, reach out to him. I'm sure you look at a lot of deals. So make sure it's good out there.
Yeah, send them my way. I'd love to look at deals. I love underwriting, love analyzing.
I love it. Zach, thank you so much for taking time out of your day. I can't wait to circle back with you. Enjoy that baby. Trust me, they grow up so fast. I know you've heard that 100 times. And and give mom a break. It's we get to do what we do because we have amazing, partners in life that allow us to go out and go on these, business ventures that we do. So, just again, my pleasure to have you. Thanks, Zach. We'll talk again soon.
Thanks for having me, Matt.
Thanks, Zach. Take care.